Go. Marcus many years ago said, after about the 5th or 6th of January, you forget who you've said Happy New Year to, and it starts to wear off, and so that's when people tend to cut it off. So yeah, we're well past that. All right, we are watching folks roll in, and Ira, while we're waiting, Ira, I'm going to put you on the spot here with your NASCAR headset there, but you were in Iceland a month ago
I was
in December.
in December.
Was it temperate or was it bitterly cold?
It was not bitterly cold. It was in the 20s and 30s. Uh, it was enjoyable. No real snow to worry about. We lucked out with the weather, big time.
Good. And that's not your first time in Iceland.
It was our second time in 2 years. We went in 2023. Loved it so much we came back, and we're trying to figure out when we're going back again. So anyone that
Oh.
needs tips and ideas and recommendations, you could reach out to the Chrisman LLC.
There you go. And James, have you been to Iceland yet?
You know what I did? I was there maybe 7 years ago. Spent a little time on a glacier. I was very jealous when I was hearing Ira talk about that. It's been a minute. Although I don't know, maybe I need to go back again. When in trouble, double, right? Yeah.
And Marcus, don't tell me you've been.
No, I haven't been to Iceland either. I'm gonna have to
Okay.
email Ira at some point for advice.
Yeah. What kind of soup to order at a particular
Yeah.
sidewalk cafe in Reykjavik? So anyway, welcome to the Capital Market Show. Uh, sponsored by sponsored by Poly, excuse me. Vertically integrated secondary marketing system. And before the show began, Marcus said that Poly has some really neat things coming our way, none of which he can actually discuss. So, Marcus, I'm sure you'll keep us up to date on those. And I wanted to introduce James. James is subbing in. I guess subbing would be too not a great term, but James is taking the place momentarily for Rob Kessel, who is on a plane somewhere. And James, do you want to tell everyone a little bit about yourself?
Sure. Yeah, happy to be here. Thanks for the invitation. Yeah, so I currently head up capital markets at First Home Mortgage Corporation, based out of the Baltimore, Maryland area. And I'm collaborating these days with Rob Kessel at Panoramic Capital Academy as well. We're just starting our second semester of mortgage capital markets education this week, as a matter of fact. So excited to be doing both roles.
Good, good. We don't ask a lot of tough questions on this show, James, but let's lead off with the influence of cryptocurrency on hedging ARM pipelines. Where do you stand on that? What can you tell the group of,
I think
you
it's the new innovative thing that's going to come out of Poly, right?
exactly.
Yeah, we use
There
it.
we go.
Yeah, Bitcoin forwards to manage your mortgage rate position. Yeah, let's wait for that one.
Yeah. All right. Actually, let's ask something that actually makes sense. And it's a question that I receive every day now, and I'm going to throw it out to Ira. Actually, I'm going to throw it out to Ira, and then Marcus and James, you can answer afterward. But Ira, you get a call from a loan officer, or you get Stephen Milner walks into your office and says, "Ira, what the heck's going on out there? The Fed cuts rates, mortgage rates go up. There's no correlation. What's going on out there, Ira? Mortgage rate, 30-year mortgage rate wise, and why?"
30-year mortgage rates are up, right? They keep going up. Uh, Listen, it's been a rough, I guess, since October. We saw obviously rates come up. We had the Fed meeting in September where they had their summary of economic projections, which is basically each Fed member projecting their thoughts on what the federal funds rate will be in the future. And, along with the Fed cutting in September. People thought that that September meeting was a little aggressive based on the data. Um, and ever since that meeting, the fears of higher for longer, fears for inflation, the economy is chugging along, as you like to say, the airports are busy, restaurants are busy, and nothing's cracking yet. And indeed, when we had the December Fed meeting and we had the updated summary of economic projections, we indeed saw each Fed member, sort of backtrack a little bit, however you want to phrase it, um, and sort of update their projections with higher for longer numbers. And until we see, any type of crack in the economy, you know, dip in inflation or anything like that, there's nothing really pointing to something that would show us with, leave us with lower rates.
All right. That was probably the most pessimistic 2 paragraphs I've ever heard you utter, Ira. But
It's just facts. I'm not making predictions, but
we'll try to overcome that. James, you're the new guy here. Anything to add to that? And Marcus, I have a special question for you.
Yeah, I think that was well said. I think, unfortunately, but I think, the thing that I would emphasize, to kind of underscore what Ira was saying is that, markets by definition, they're forward-looking. They're not looking at today's data. They're looking at, they are, but they're looking at what's going to happen next, what's going to happen in the future, especially when you're talking about long-term assets like mortgage rates, right? And so I think right now what we're seeing is kind of a transition period where, to Ira's point, the data has been quite strong. The most recent jobs report was quite strong. There's no immediate evidence that the labor market's rolling over or anything close to it at this point. And so with that in mind, that's, when you take the long-term view, that presents some uncertainty, that presents some volatility. The market was expecting the Fed to be cutting rates at this point and guiding us all lower, that is, in the future. That's not really the case right now. So I think just when you look at kind of what drives buyer behavior, investor behavior, when you look at kind of the catalyst, if you will, to jump in and say, yes, now's a good time to be investing in long-term assets. At present, it's just kind of less there than we would want, and certainly to Ira's point, than we thought the market would be 3 to 4 months ago.
Yeah. Marcus, you have dealt with investors for many years, probably more years already than you care to admit. Why would, if rates are, potentially going to creep up higher, maybe, and we're not here to predict that they are, but why would any investor want to own any fixed income security in this environment? Who's buying securities out there? Fixed income securities.
Yeah, it's first of all about the predictions. Funny comment you just made because I had drinks with my old boss, John Boyles, a few months ago. He said that every time he listens to me talking this thing, I've been wrong about my prediction. So let's start there.
Leave it to John to say that.
Yeah. As for who's buying, I mean, funds, I don't know. I mean, I feel like there's investors out there that are taking a large gamble on the fact that they think maybe rates will fall, and they're using that opportunity to sweep up as much as they can to refi that borrower and own that borrower for much longer lifespan for that transaction person. I don't know.
Okay. It's hard-hitting, definitive answers like that, Marcus, that keep people coming back to this show. Ira, you track servicing values, which I'll get to here in a moment, but I'll answer that question a little bit, Marcus. But if I were a loan officer, I would be asking, well, if mortgage rates go up and the Federal Reserve, is anybody even talking about the Federal Reserve cutting even further if the economy is doing well? Ira, have you heard any talk creep into the market out there, or James, in terms of, gee, maybe the Fed's next move is going to be an increase?
I'll start. I haven't really seen that projection. I think that they're leaving the door open, perhaps more than they thought that they would. The sentiment that I've seen recently really comes down to fiscal policy. Frankly, they don't know what to think about the potential for tariffs and what that's going to look like in the future. And it was kind of striking because previously the Federal Reserve Chair Powell very firmly went out of his way to say we don't speculate, we don't project, we don't anticipate what's going to happen. And then, we saw the minutes from the most recent meeting, and there was a lot of speculation, there was a lot of prediction, there was a lot of hand-wringing about what was going to happen in terms of fiscal policy out of Washington. So I think that they've opened the door perhaps a bit more than they think, but I think at the same time, the Fed, rightly so, really values their credibility, and they've set a course. They feel good about their dual mandate of lower inflation and full unemployment. And so I think at this point, they're kind of in the same boat that a lot of investors are, in that they're more wait and see. They keep underscoring the fact that they're data dependent. And with that in mind, we're seeing, I think a little bit more market volatility than average around some of these new economic data points, like the PPI report this morning, perhaps, or certainly CPI tomorrow. So I think just in general, I don't think that they want to raise rates. I think that they would view that as, a disappointing development and opposite of what they had guided us toward. But at the same time, I think that they were certainly wait and see, and they're going to follow the data.
Ira, any other comments you might want to throw out there that you've been talking to loan officers or answering loan officer questions on?
Yeah, just to your point with in regards to a Fed hike, that really hasn't come up. I think it's something in the back of everyone's minds a little bit, but it really hasn't been out there that much. We have seen the potential for the next cut push out a little further, so we're looking June, July approximately. But it will be interesting to see the next two meetings. We have the next meeting in 2 weeks, and then the one after that's in March. So it will be interesting to see the impacts of any potential, items from this new administration, to see how that pans out and the impact of not so much the Fed action, but what the Fed says during those meetings.
Yeah, the Fed doesn't have to do anything, right? They can just, the Federal Reserve, the Open Market Committee can just sit on its hands and do nothing. In which case, and I've been telling people, well, if you like mortgage rates where they are, maybe you'll like them into the summer, and so we'll come back to strategies for originators and companies to roll out or to do, but I didn't want to leave the value of servicing kind of hanging out there. And Marcus, you follow the value of servicing, and the value of servicing goes up and down just as much as the mortgage-backed security market goes up and down. What have you seen recently with rates having crept up? I can guess the answer, but I'll let you elaborate. What's going on with servicing out there? Just good old Fannie, Freddie, conventional conforming. We'll get to government in a minute, but are you seeing any big trends out there with the value of servicing?
No, other than that, they're extending a bit, but the rates in general, I was looking up the data in our system right before this call. They've crept up quite a bit, and I think a lot more than I had realized, but we had started December at like 6.65% average 30-year fixed owner occupied for retail. And this current week, our data is showing we're almost at 7.25%. That's for what's being locked in the poly platform. So, there's definitely a fairly dramatic uptick in that. And I'm assuming that with that comes, the change of servicing values as rates tick up and so on.
Yeah, 7.25%. That's a pretty high 30-year fixed rate mortgage. James, are you hearing or seeing, have you seen any statistics about decay or increased delinquencies on FHA servicing?
We have
I've
started
been
to see that.
rumbling out.
Yeah, we have started to see that a bit in some of the most recent prepaid data and some of the most recent issuance data. We've started to see Ginnies creep up a bit more than we would think, than they have been, I should say. I think one of the things that's been interesting, however, is, you know, as rates continue to go higher and as home price appreciation goes higher, and we hear about the challenging housing market, I think it's at least it's intuitive to me to think, oh man, we might start seeing credit start to decline a bit in terms of the average borrower. But really, we're seeing the opposite, which is somewhat striking. I think that if we look at the credit profile of government servicing and specifically FHA, it's actually increasing, especially on the purchase
Really?
house. Yeah, that I was looking at this earlier that in the last couple of years, we've gone from, you know, kind of that mid 670 FICO score range to in the low 690s actually for FHA purchase, which again, for FHA purchase business is quite strong. So we're continuing to see a pretty strong borrower, all things considered, on a relative basis. In that particular cohort. So we are starting to see delinquencies creep up a bit, but at the same time, the credit performance is hanging in a little bit more than certainly I would think would have perhaps expected a year ago.
I can't explain that one.
Now it's interesting. We are seeing in recent months the refi credit profile has started to, or in recent years that is, has started to come down a little bit and diverge. But yeah, it's a somewhat striking, somewhat surprising kind of development.
It's interesting that right now, and I wrote about this last week, but the you know, the NBA releases the applications data from the prior week, Wednesday morning at 7 a.m. East Coast, 4 a.m. West Coast. The last batch of data showed that 40% of applications are refis right now, which is on the one hand astounding. It's like here we are at 7 or 7.25%, and yet 40% of the apps are refis. Ira, where are they why? Where are they coming from?
Yeah, I mean, we're seeing an uptick in cash outs. Obviously, you know, rate and terms are, you know, they're sort of out the window right now with all the business done in 2020, 2021. But there's still, as was just mentioned, a lot of consumer debt and credit card bills, holidays, all that Christmas shopping, New Year's shopping. So, you know, with all that consumer debt, we are seeing an uptick in cash out refinances. Um, you know, people trying to take advantage of the equity in their home. You know, unless they're selling, you know, where else are they going to get this money? So, you know, it's out there. The pricing adjustments are not pretty with them. We have seen a little bit of an uptick in HELOC or HELoan applications come in. So, you know, other equity products. But, you know, you still have a cohort of borrowers with rates in, you know, the sixes, mid sixes that are still willing to, you know, do a cash out refi even at these elevated rates if it means getting cash out and paying off some of their debt.
Yeah, there were a couple chats. Yeah, I would say applications dropping, and that probably helps the refi percentage. There was a prior question about the application data. The application data is just that the week prior. It's not the apps aren't too old. It's pretty fresh data that the NBA puts out there. And of course, applications don't necessarily translate into fundings, but it is a good kind of first line measure of what's going on out there business wise. Marcus, can you share any of the information that you're seeing from Polly's perspective? And once again, thank you to Polly for sponsoring this. But you know, Polly has its proverbial finger on the proverbial pulse of information flow coming in right from the start. What are you seeing out there in terms of pipelines, in terms of application data?
It's a little complicated on the data side just because we have like a global view of what's being run through our system, and it's hard to delineate the data between what's like it's hard to delineate like if a customer is going through an M&A or if we're adding more customers in a certain state to see like volume trend up or down. Generally speaking, I would say that we've seen volume kind of fall off the cliff in December and pipelines shrink considerably. I've talked to a number of customers where their hedge position had fallen dramatically kind of in the last 2 weeks of the month. With that said, with the rates as high as they are right now, there is something I can share about Poly is that we are working on an extremely robust like renegotiation tool and mechanism in our system, which basically involves like the complex formulas and rules and milestones and statuses to getting that in there. So, like I said earlier, with the rates at 7.25 right now, there is like the possibility of renegotiating that position at some point in time. I don't know. I don't know. Maybe it's like defensive mechanism to lock now versus the fear that it keeps creeping up.
Yeah. I've talked to several loan officers who have transitioned not fully to non-QM or private money, but are certainly supplementing their income through doing non-QM or to some extent FHA, but also private money, because it's pretty easy. Like James, I know you probably don't know Ira's financial health, but Ira's we call him a zillionaire, and he lends private money out all the time. I mean, it's crazy how much Ira lends out on a weekly basis. But on a more serious note, originators are scrambling to some extent, or have at least shifted their business model. Certainly companies are more open to non-QM. Certainly they're open to other programs that might not have been open to earlier or in previous years. But private money, I would say, is certainly helping many originators out there because they're pretty easy to do. Ira doesn't require a credit report. He doesn't require, all kinds of information that a regular loan would require when he's dishing out his own funds. James, do you see in your role in terms of the academy, switching gears here a little bit, you have a semester under your belt, you have the new semester that's starting. What can you tell us about, is there an average person who is signed up to learn about secondary marketing and capital markets through the academy? Or is it soup to nuts from, the secretary through the lock desk up to the CEO or owner of a company? I mean, what is the average student?
Yeah, to your point, it's really all over the board. And I think that reflects kind of what's going on in the market today, that we have perhaps the return of private capital to some extent coming. We have, a challenging rate environment where we're being asked about what's happening in terms of where rates are going and in terms of how, all this stuff works together. In these types of environments, every basis point counts, as they always do, but especially now when that basis point might shift you from the red to the black. So yes, it really runs the gamut. We're seeing, we had a few loan officers that have joined this year, or branch managers. We've had a few representatives from C-suite. We've had a couple people from a private equity background, a couple people from a technology background that, very often, kind of in my previous role at Compass Analytics and Optimal Blue before I joined First Home, I worked with a number of very talented developers and IT professionals, for example, that absolutely knew a great deal about the mortgage industry, but how do you take that to the next level? How do you better communicate with your business representatives and so on? How do you have a more direct conversation? So actually, that's been a lot of this conversation too, is how can someone who is perhaps working in the mortgage industry but isn't, maybe a secondary or capital markets expert, take their knowledge to the next level. So yeah, it's been kind of everywhere. I'd say if there's a model student, they tend to be somewhere around that kind of director level, that they work for a lender, they work for someone in the industry, but they're really looking to I've started on the lock desk, maybe I work in secondary even, but I've never had the opportunity to do servicing cash flows. And so some of the questions you were asking earlier about, what drives servicing valuations, how else am I going to find it? So it's been really interesting. And very rewarding for that matter to see so many different opinions and perspectives.
I'm going to put Marcus on the spot here. Marcus and Polly on the spot. Marcus, I've been a few times to, I think it was in Compass. Was it in Compass where they have they rent out like a whole hotel or a convention center in Las Vegas, and they just have room after room after room of sessions. Maybe it's ice or anyway. Does Polly offer classes to users for, given that you're vertically integrated, which sounds really cool, but how do you teach users to use everything that you have to offer? Is it one-on-one individual lessons, or do you say, okay, next Tuesday at 11 o'clock, tune into this Zoom call, and we're going to show you how to, how we price non-QM loans?
Yeah, that's a great question. So we do have a lot of corporate training. So we do have one person that does like he runs the entire corporate training department, where there's user guides on how to use the system. He does the trainings, tutorials. He works with all kind of like the admins, the cap markets team, and so on. And then on top of that, we have the CSM team, customer success manager, that'll have like weekly cadence calls with new customers, training them how to use the system, how to configure margins, how to configure automation. There's like a lot of work that we do together. On top of that, we have an AI co-pilot that we're working on, that we're thinking about. We're integrating our user guide into that co-pilot, so one officer can just speak into the microphone and say, well, how do I don't know, how do I change a product in a specific loan? And then the response will ping back with like, okay, to do these steps, go here, here, and here. So yeah, I don't think we're at the stage yet in our corporate evolution where we can rent out an entire Vegas hotel and have a dog petting area with vendors all over the place and cool things like that. But we'll get there at some point. I bring that up because at the ICE conference last year, there was a puppy thing that I may have squirreled out a bunch and gone over there and did that instead of my job.
Ira, do you have a dog?
I have 2 dogs, and right now in my house I have a total of 5 dogs, so it's a little hectic.
What are you, like, handing out pork chops at the front door or what? Why
Yeah,
you
you caught me.
right. Well, anyway, Ira, getting back to what I think people are tuning into this call for, I'm certainly to learn about the academy and certainly to learn about Poly. But what takeaways? I mean, what do you tell senior management? Like I said, Stephen Miller stops in and says, "What the hell?" Well, actually, Stephen doesn't swear like that I know of. He's very gracious, but what's going on out there? Are we going to be at 7.5, 7.25 for months? Here's what we need to do better. Here's what my origination staff needs to know about going forward. Ira, what would you tell him?
Yeah, so I mean, internally, I actually hold a weekly call with our company. So it sort of gives all of our staff, and we invite our salespeople, we invite our ops people, anyone that wants to hop on internally. And I just go over what is going on in the market, what went on last week, what's going on this week, um, things coming up in advance. You know, it's tough because you can sort of only play with the hand you're dealt with, right? And you can't make predictions on rates. You just have to sort of remain neutral. Keep your hedge at your modeled numbers and not try and make predictions on the rate market, right? Work on the originations, work on getting the business in, working on recruiting and expansion. But when it comes to the market itself, just sort of you can't worry about what's going to happen in the future. As far as loan officers, obviously, limited inventory, everyone's competing for homes. You know, anytime rates dip down, you're going to see that competition for homes increase. Not only that, a borrower that purchases today, in the event that rates do come down, that's great. They're going to be able to refinance. But if they don't buy today and they decide to wait, when rates do come down, I'll give the optimistic spin. When rates do come down, they might not be able to get that house that they were getting now. So it's always a good time to buy. You're always going to be able to refinance later eventually. And that's sort of the way, you just sort of have to proceed.
Yeah, there's a witty quip out there about, um, the best time to buy a home is always, 3 years ago. Consistently, it's always 3 years ago. Um, yeah, I would say that, yeah, it's a very tough environment. Originators are doing what they can, companies are rolling out what they can. I would certainly say that the mergers and acquisitions environment is ripe for some big news. Uh, we have M&A that's going, and we're going off of capital markets here somewhat, but just in terms of the overall environment, all branches are moving around all the time, but I wouldn't be surprised if within the next week we hear about some big, uh, headline kind of news out there, because lenders are still, no one's getting any younger. Companies are still looking at their options and saying, okay, do I really want to manage a company or own a company where 7 or 7.25 is the norm going forward? Or is it time to, look at my options? Or if you're a big company, look at the channels that you have, wholesale, retail, correspondent, direct to consumer, and say, okay, does that really fit into our long-term business philosophy? Um, James, First Home, that's the name of the company.
It is.
What is First Home?
Yeah, so we're a retail lender, kind of based out of Baltimore. We're up and down the East Coast, but we're heavily concentrated in Maryland, DC, and Virginia in particular. And we're in a lot of ways a really traditional kind of old school mortgage banker. We work very closely with real estate agents and title companies and referral partners, and we try our best to be educators, which dovetails nicely with my work at the academy. But really, that I think germane to this topic here is to kind of go off of what Ira was saying for a minute. That's been exactly what we've been communicating to. That's what our loan officers have been communicating to borrowers, is understanding what's going on in the market, understanding that, when we hear people say, oh yeah, well, rates are a little high, where's one of those 3% mortgages and so on, it's like, that's not coming back, understanding what's going on in the different trends, and then letting people make an informed decision. And that's really, really been our focus, is explaining kind of what's going on in the market, explaining what is and isn't going to happen. None of us have a crystal ball, but certainly if we look at market projections from folks a lot smarter than myself, the Goldmans and Morgan Stanleys of the world and so on, the general consensus is that, to your point, we're going to be here for a while, rate-wise, give or take, right? There's some pockets of optimism for sure, but explaining that to a borrower and then saying, this is one of the topics we've been having, here out in Maryland. It's right in the middle of winter, right? And so seasonality is a real thing out here. Yeah, it is actually a half decent time to go house hunting, because if we do have an opportunity and rates dip and all of a sudden it's spring and there's no snow on the ground, right? It turns out that there's a lot more interest and there's a lot more people looking at that. So I think it's taking a step back. It's explaining where we are in the cycle. It's explaining where we are in home inventory. And that from a first home perspective is really what we try to communicate to our borrowers and communicate across the organization.
Do you do business in Southern California?
We do not do business in Southern California.
Well, Southern California has certainly been in the news here in the last week with the fires and the impact of those fires. Obviously, anybody who's been in a natural disaster, whether it's a tornado or a hurricane or a fire or an earthquake, knows the fear and the uncertainty that goes along with that. And just, you have the human life toll, which we're witnessing. And then you also have questions from borrowers who, do I make my mortgage payments? What do I do? My house isn't standing anymore. Why should I make my mortgage payment? Ira, does US Mortgage do business in California?
not in Southern California right now. So we don't have any affected areas, affected homes in the area. But it is, it's quite scary what's going on there. And, it's problematic, right? It's not only problematic now, it's problematic down the line. We saw what happened in the Carolinas. Um, and it's going to continue into, for the foreseeable future.
Yeah, it certainly impacts servicing values. And a question popped up in the chat about, what's going on there. The state of California has policies and procedures. FEMA has policies and procedures. And when FEMA declares an area, a disaster area, lenders and servicers, they have policies and procedures that kick in automatically in terms of loans in process, inspections, appraisal, and how to handle that. I would say California, and I'm just speaking totally out of turn here, but I would say if I had to guess about California's borrower protection policies that are out there, I would say it's stronger than many other states in terms of protecting consumers who've lost a home or whose home has been damaged in terms of forbearance or in terms of whatever. And it comes down to, right, comes down to the borrower contacting who's ever servicing their loan and saying, okay, here's the status. What do we do? Where do we go from here? I know the IRS just came out and extended their tax filing and so forth, and different companies are doing different things. But yeah, nobody wants to force, if you've just lost your home, you don't want to be Simon Legreed and say, well, boy, you got to make your payments or else. I think there'll be a lot of that. But one of the things that I keep raising in my commentary is the impact on housing stock. Different areas have different inventory issues. This isn't helping the Southern California inventory of available homes for sale by any stretch of the imagination. And on top of that, when you look at the Carolinas and when you look at Lahaina, or if you look at some of the areas in Florida that have been impacted by hurricanes, it's not a problem that's going to go away in a couple of weeks. It's going to take years. I received an email from a friend of mine who said his family was putting in a new deck in Northern California. He said it took 3 months just to get a permit for a new deck, okay, in Northern California. So California bends over backwards for consumers, but also the permitting process can be very onerous. So hopefully the local municipalities do something about that, and it certainly impacts servicing values, I would imagine. All right, I'll stop rambling because people didn't tune in to hear me ramble about that. But it is an issue that is becoming more of an issue as the years go on in terms of storm severity. And I'm not going to get into the climate change or climate catastrophe discussion, but it is something that everybody should know about. And we try to band together and help people who've been impacted. So yeah, but it's going to be a problem that we're going to have for quite a while. Going back to Marcus here somewhat, Pauly sees this data. I mean, do you see a disaster? How does a disaster make its way through Pauly's system in terms of pricing, in terms of the services that you provide lenders who are in that area?
Yeah, I mean, really, I think it's similar to most disaster kind of just rules in the pricing engine, where you could put specific addresses, geocodes, census tract IDs as rules in the system saying, before you lock on this, maybe you need to have like a custom field that designates this property has been inspected or something along those lines, just so an added layer of protection for the lender that they're not putting a lock on a property that that's underwater, or that's on fire, that maybe it's no longer there. I mean, who knows? But essentially, any field in their system you can write a rule off of, and lenders would utilize that functionality accordingly.
Yeah, just
There you
to
go.
add on to that, for those that it's people don't know, it's not just that loan closing in time, or having that inspection for the closing. That loan has to be sold off. So if you're selling to an aggregator, they're just going to halt purchases, and if that loan closed, you're going to be sitting on that loan until you get that reinspection. So it's not even a matter of closing the loan; it's a matter of getting that loan sold off somewhere.
James, did you have much exposure in the Carolinas when the hurricanes rolled through? Hurricane.
Yeah, we were fortunate. We do a little bit of lending in the Carolinas and in Florida, and so far we've been very fortunate that we haven't had any affected properties. I think one of the questions I saw in the chat, and I think a relevant point to this as well, as you talk about kind of the long-term implications, is when we talk about home price appreciation and affordability, so often we in our industry think about the principal and interest, but this also goes into home insurance too. And that's a cost that continues to increase, right? And that's a cost that continues to be a strain as well. And that's something that, as we think about kind of long-term implications, good, bad, otherwise, wherever everything's coming from, it's simply the reality that we're seeing a lot of disasters recently, and that in addition to inflation is influencing home insurance prices too. So it's something to be aware of. It's something that I certainly don't have a solution for today, but at the same time, it's an increasingly relevant portion of the affordability proposition too.
James, I'm disappointed that you don't have a solution to the insurance crisis today.
I'm working on it. Give me a week.
Okay. Okay. Yeah. Insurance. I mean, if you think about the economics of insurance, I have a neighbor in Northern California who she was paying like $300 or $400 a month or something, homeowners insurance, and she went away for the summer and came back, and her upstairs bathroom, and it's a kind of a funky house, but she has 3 stories, and the bathroom on the 3rd story, the toilet from 1959 sprung a leak and flooded the house, and it had, there was mold and so forth, and it's going to be hundreds and hundreds of thousands of dollars to repair that damage and replace her structure. And I told her, I said, you've been paying $300 or $400 a month for I don't care how many years, but there's no way that your insurance premiums will come close to covering the cost of redoing the structure. If you look in Southern California, some of those houses, I don't know, 5, 10, 15, 20 million bucks. And I would hope that most of them are insured, but I don't think their premiums ever came close to covering what the expense is going to be. I've been hearing these, billions and billions, $250 billion, or I mean, just it's staggering. Anyway, I wish I could end on a high note. Ira, close out our session here today with something optimistic, something cheerful.
Well, we didn't say Happy New Year, so I guess I should say that. Is it too late? I know we've discussed that.
Happy New Year.
Things will, I guess, if we have to get the positive, things will get better, right? I hate saying we've been here before, but many of us have been through these cycles. And we just have to remain strong, and things will get better. They will. The economy, frankly, can the economy still remain strong for this long, this high? Things will crack a little bit, and we will see rates come down eventually.
Very good. James, thank you for joining us.
Absolutely.
Good to have you. Marcus and Polly. Marcus, thank you for joining us. Polly, thank you for sponsoring. And Ira, thanks for ending on a cheerful note. And enjoy. I hope all your football teams are victorious, and we'll chat again in a month. And with that, over and out.
Cool. Thanks, everyone.
Thanks, so.